Thank you everyone for joining us today. We'll just wait a moment while Zoom loads all the attendees in. Right, thank you so much for joining our State of the Industry today. We're really excited to be able to hosting some excellent panelists for you all, give you more updated data on what's happening in private lending and making sure that we're putting as much information in front of our members as we can, actionable data that you can use. So before we go ahead and get into the meat of the webinar, I did want to offer our usual quick announcements. So we, of course, have our 14th annual conference coming up this November 12 through 13, still in Las Vegas, still in Caesar's Palace. The one specialty thing that you're going to see this year is Formula One is happening later that week. So we do expect to have a very, very busy Vegas. You will want to book your hotel room soon, and you'll want to register for the conference also. Our early bird has ended officially. So if you are not a member, you can bundle membership in and get $100 off membership. And then if you are a member, you are always going to get that early bird rate. So another good reason to be an AAPL member, you can save some money on your annual conference ticket. We are expecting an even larger crowd than normal this year based on what we're seeing so far. So we expect more than 700 attendees, and we're really excited to be welcoming you all for some excellent education, hot market information, and all the wonderful things that you've grown to expect from our conference. Next up, we do have our online certified fund manager and certified private lender associate courses. They are members only, and they're available for $349 each at aaplonline.com/courses. They're incredibly good introductory courses to private lenders. We have both beginning and experienced private lenders who go through them for credentials. We're just really working on trying to make sure that we're bringing the best education and credentialing to the industry so that we can support our members. If you have any questions, you can reach out to us at contact@aaplonline.com. Next, some housekeeping as we begin our webinar today. As many of you know, State of the Industry, the actual live webinar that you're watching right now is members only. So we do encourage you to register and watch live because we delay the recording of this pertinent and very timely information for 2 weeks if you catch up with us later. So go ahead and mark your calendars as we send out newsletters for future webinars, because we do want to make sure that you can get the most up-to-date information as quickly as possible. As far as asking questions during today's webinar, please use that Ask a Question feature to add it to the queue. We have a little bit more trouble following questions in the chat window. That's where we encourage you to place discussion, thanks, what have you, just because we can more easily follow and make sure that we're addressing all of your questions as you have them. So Nema will be keeping an eye on that and either bringing them up during the webinar or at the end when we have questions. And post-webinar, you can reach out to us at contact@aaplonline.com with any questions you have to make connections with today's panelists, or really anything else that you might want to have a conversation with us about. So with that, I'm going to hand things off to Nema to introduce our excellent panelists today and the topic for today's webinar.
Great. Thank you so much, Kat. Appreciate all that you do there at the association and the association as a whole. Thank you, everybody, for joining us here today. My name is Nema Daghbandan. I'm a partner with Drossy Law Firm, and I'm also the CEO of Lightning Docs. I'll talk about Lightning Docs in a second here. But before I do, just want to have our panelists tell us briefly about what they do for those that may not know who they are. So Rocky, why don't you lead us today?
Sure. I'm Rocky Butani, founder and CEO of Private Lender Link. We operate a website where people find direct private lending companies. We're also a good source of information for industry news content about private lending, and reach out to us or visit our website, privatelenderlink.com.
And Rick, go ahead.
Hi, I'm Rick Sharga. I'm the founder and CEO of CJ Patrick Company. We're a market intelligence firm supporting companies in the real estate and mortgage space. And I've been involved in real estate and mortgage data for a better part of the last 25 years. So delighted to be here and join you today.
And thank you, everybody. So a little bit about today's presentation. We've got a lot of data. I think we've got 56 slides in total. That's what happens when you get Rick on board, because Rick gets, it's amazing. I've already been able to review it all, obviously. We are pretty lucky to have this sort of content and amount of data that he's pulling, because it's both national, as well as down to a bit on the regional side. And it's going to be all the stuff that obviously you're going to be interested in, which is, foreclosure starts and starts in general, and lots of really detailed information to get a good understanding of kind of what's happening, particularly from a macroeconomic perspective. For those of you who have joined us before for the state of the industries, I usually like to start with a little bit of data out of Lightning Docs. And kind of what the heck is Lightning Docs for those that are uninitiated here. It is the software solution we built at Gerasi Law Firm. It's the official loan documents of American Association of Private Lenders. We've got the data set itself is almost 40,000 loans now, and a little over $21 billion in total loans being analyzed. Obviously, that's since 2018. It's generally about $1 billion a month or so that we're analyzing currently. And it's typically around 2,000 or so loans that we run through there. The loans are all private lender loans. There's no, no institutional or any other sort of lenders that are sitting within the data set. So it is very specific to our space. And where appropriate, we will segment what is a DSCR loan from what is a bridge or RTL or short-term loan when we're looking at the Lightning Docs data set. And then I'll hand the keys over to Rick here and let him give us a big macro understanding of what's happening out there. So the first thing here is let's talk a little bit about the bridge volumes that we're seeing here. So when I'm demonstrating any sort of slide on volumes, the way that I'm going to be looking at the data here is I'm going to look at the same users that start at the time period. Here, the time period that I'm looking at is January 1st of 2023. So as long as a user was a user of Lightning Docs prior to January 1, 2023, what has happened with their volumes? Because obviously if you had new users, volumes will get skewed. So we're taking on any sort of new noise and just looking at those exact same people. You'll see other slides where we'll go take a deeper look back and the exact same analysis is being done here. So here, when I describe it as a bridge loan, it's an interest-only loan. It's got a duration of 3 years or less. And that's what I'm looking at here in the data set. So when we're looking at volumes, you're seeing an appreciable increase, obviously, from January to July, right? Almost a 50% increase from these. But if you actually kind of parse that back for a second and take out some of the noise that sits on this chart, what you really see is a big increase from January, February to March, and kind of a plateau from there, right? A slight increase and a steady eddy that's happened from that point, right? You've seen some increase, 7% from March to July, but effectively it's mostly moderated starting around March. And I think that's kind of been the story that you will often hear from a lot of the users. And I think, Rocky, you also have seen this as well.
Yes, this is exactly in line with what we're seeing on Private Lender Link in terms of traffic, where January, February were low, and then it increased in March. June was also a good month for most of the lenders on our platform, and July, August typically tend to be a little bit lower. That's historically a common trend we've seen over the past 5 years.
And it makes sense too if you just kind of, Rick will obviously be involved in the macro, but what did we start seeing as a plateauing of the interest rates, right? So maybe we're kind of seeing what we will call our new normal 2.0 here for a little bit, but very interested to see, how can we analyze that? So the next thing here that we track within the Lightning Docs data set is also trying to understand is what is happening both with interest rates as well as average loan amounts. What you're seeing here is a confluence of two things, obviously a rising interest rate market, but you're also seeing a reduction of risk. And the way you see the reduction of risk, at least in my world, is you see it in lower dollar amount, average transaction amounts. And that's really just translating to lower LTVs as the end product. So here, when you're tracking the interest rates to that exact same time period, we're basically hovering in the low 11s, and this is the national rate, right? And I've done a little bit of reducing of noise here as well, as I reduce anything that's less than 4%, because that's probably a mistake of some kind, and anything greater than 15%, even though we do have lenders who will make loans above 15%, that's for sure the anomaly. So, the vast majority of users are going to be between that, probably 9 and 12 or so currently. And so this is what we're seeing here from interest rates, a little bit of an uptick, a little bit of downtick, but this is what we're seeing nationally. And from a loan amount perspective, we're seeing your average bridge loan amount hovering in the low $400,000. We have some slides coming up in a little bit too, which will talk about how real estate is obviously very local, and you'll see that particularly for loan amounts, that a national number is interesting, but it doesn't really mean anything because you need to understand what the prices are in that market. So when we say that we have a national interest rate in the month of July of 11.16%, when you actually break that apart and you kind of look at this and say, so what are the handles that you'll find there? And you've got 10, 11, 12% are the dominant, right? So your 85% of loans have either a 10, 11, or a 12 dot something in their interest rate, right? So it could be anything, when it says less than 10%, that means that there's a 9 dot or lower that precedes the number. And you're seeing is that there's very few 9% loans in the market. And a decent number of 10s and a decent number of 12s, and everyone else kind of sitting in the 11s. So now let's take a look at this when we deal with the rental loan volume. So now we're looking at the DSCR loan product here, right? So a 30-year loan is what I'm now looking at when looking at the product type and looking at volumes there. The volumes are kind of moving pretty, all over the place, but, so I've got the bigger areas or the bigger arrows, which we'll concentrate on for a second here. So when we're looking at the arrows, what we're seeing here is similarly big increase, slightly more. If you guys recall from the previous one, I think it was around 50% increase from January to July, slightly greater here for DSCR. And when you kind of take out the noise of January, February, and just says, let's look from March on. And again, slightly more increase. I think we have around 7% for Bridge, if I recall correctly, and here you're closer to 17%. So still kind of humming along and going well on that side of it. Anecdotally speaking, when I speak with our our DSCR users, their commentary up to this point is basically, yeah, volumes are great, margins are not, and so it's still not a great time to be in DSCR. But at least the volumes are there, right? There's still a sheer number of transactions that have to transact, even if the ultimate end purchase market, which is primarily life insurance company at this point, and they are calling shots and they're not giving great economics. So we're seeing that on that side. There was a question I saw over in the Q&A, which is, when we're discussing interest rates, what does that include points? I'm just looking at the nominal note rate. This is exclusive of underlying points in the transaction. So you're going to obviously have to add that in. This is not the net of it all. It's just the sheer interest rate written on that note. So next one here is now looking at get the slide to move. There we go. So now looking at the interest rates that we're seeing here. And actually, before I jump over that one too, is Rocky, I know you see a lot, you track DSCR as well. What are you kind of hearing and seeing as it relates to DSCR?
What I found with most lenders is that DSCR on average is about 20% of the total loan volume for most of our lenders. And the 80% is all short-term lending. I've seen a bunch of lenders that have just, they still offer DSCR loans, but they're not that excited about it. They're not really pushing to do a lot more of them. It's more like it's a secondary product that they offer to their customers who rehab a property and then want to keep it, instead of going out and marketing to get a lot more. And the reason is there's not as much volume as it was back in 2021. And the loan amounts are typically smaller for these types of loans. So I see a mix. There's some lenders that are still bullish on it, and a number of lenders are just, not that excited about it anymore.
Right. And that's a really good segue to our next slide here, which really deals with, well, now what are we dealing with on our interest rates, and particularly our loan amounts is, they're fairly small transactions still when you look at this nationally. And again, this is national data. Oftentimes DSCR loans in many markets are closer to 100,000 or in that range. And so and oftentimes the economics are about a point or so. And so you can really quickly see how it's not currently the most income producing product for a lot of the originators. But interest rates are really, pretty flat as well. You're just seeing it hover right around 8%, a slight uptick. And that makes sense, I think, for people who've been tracking the market recently, which is, the Fed said, we're the gas isn't necessarily off and the market's starting to price that in. And so a slight increase, the DSCR product really ties directly to treasuries and is almost a one-to-one correlation. So where treasuries goes, where DSCR rates will go on any given time period. And then similarly to segment out the interest rate, right? You have an average interest rate of 8% for the month of July, and it bears out from the numbers perspective as well, right? So loans that are written at 8 point something is 75% of the market, and almost equally at 7 point something or 9 point something, with really, nothing less or more than that.
Yeah, I'm seeing something similar where it's 7 3/4 to 8.5 is typically the average range for most DSCR loans.
Right. So now let's go in and start looking. The reason why I specifically had asked for Rocky and Rick here is we finished Q1 and Q2 of this year. So I thought it was actually a good opportunity to reflect for a minute and kind of take a deeper look at how are we all doing? And you can't look at Q1, Q2 of this year without looking at last year. And so we're going to now step back and take a deeper dive and a further look back here. So again, from a data set here, previously I was showing you users that were users as of January 1 of this year. Now we're going all the way back to who are my users as of January 1 of last year. Now let's look at their bridge loan and their rental loan volumes, and let's start looking at those products. And instead of looking at it month by month, we're now looking at this quarter by quarter to get an understanding of what is happening and what has happened from what we probably think of as the peak of those times, right? So in bridge, at least from this data set, the peak of Q2 of last year, and where are we overall? So when you look at the volumes, you see a pretty big drop off from Q2 all the way down to Q4 of last year, and then a bounce back, right? So about half those gains were picked back up going back into Q2 of this year. So when you kind of trend from peak to trough overall from a bridge loan volume, still down about 25% from that peak. And that's kind of what we're seeing here. What are you kind of hearing and seeing, Rocky?
Exactly in line with what your data shows. As 2022 was really an anomaly, and even in 2021, before the interest rates increased, you had a lot of lenders that were ramping up operations, hiring a lot of people, and a lot of lenders want to look back and say, okay, well, what's our volume compared to our peak of late 2021, early 2022, and it's kind of a tough thing to do because we'll probably never have a time like that again, and so maybe it's a bit easier to compare the current volume to 2019, which was a fairly stable year, but according to your data, I'm seeing exactly what this graph shows is that third quarter last year is when things started to fall off. The fourth quarter was extremely painful. There were a lot of lenders that paused lending, a lot of lenders that shut down. January, February, a lot of lenders were telling me that volumes down extremely lower than it's been in years. And then the second quarter was a lot more optimistic and not as higher as numbers as people want, but definitely in the right trend. And a lot of lenders are starting to ramp back up in terms of marketing and hiring people. A lot of people were let go of with certain companies over the last few quarters, but there's a lot of other smaller lenders that are making a big push and starting to hire. So that's what I've seen over the last few quarters.
Makes sense. And then the next thing here is we'll do the exact same analysis we just did, but now just switching over to DSCR, right? So what are we seeing there is technically for Lightning Docs users is that peaked in Q3 of 2022 and has had declined from there. And so you're seeing, in the previous slide, we saw volumes down about 25% in aggregate from peak to trough. And here we're seeing volumes down about half that, right? So DSCR from a volume perspective has survived better But again, I don't think that that's the story necessarily with margins or profits, but you're seeing a little bit of an outlook here where it kept accelerating in Q1 and Q2 of last year, all the way up to Q3, and then a shift downward, with the last quarter being the worst quarter in the last 18-month look back here. And what are you kind of hearing and seeing on that side of it, Rocky?
Very similar. I was surprised about the second quarter volume being down, although I guess at that point maybe it's because of the interest rates where they did increase a little bit over that time period.
Yeah.
But yeah, that's in line with sort of what I've seen.
Yeah, and I think what from a data perspective, what you're seeing here too is that this is also tracking those same users. So what's interesting, I can, at least from the Lightning Docs perspective, is that a lot of the newer users are using it for DSCR purposes. So there's also an effect in which there's a lot of entrants coming into that space, and particularly what I see is the new entrants are often got primarily, they're more institutional in nature, had more of a consumer mortgage arm, and so now they're just trying to figure out how do they survive their new normal without a thriving consumer economy, or particularly a non-QM economy. And so their gateway drug into our space is DSCR, and the really fun ones will maybe throw a fix and flip in there too, but that's also what we're seeing in terms of at least the users within the system. And so then just kind of looking at this, just Q1 year over year, what are we seeing, right? So when we compare 2022 to 2023, and just in Q1, right, went down 26%, went down 23%. So, kind of consistent look backs here in terms of how the volumes have gone down over time.
And Nema, I forgot to jump in earlier when you were talking about bridge loan interest rates, and
yeah.
What I've seen with that is most lenders are between 10.5% and 12.5% on a national scale. There are some lenders that are a bit lower in California, but for the most part, it's in that range. And then even the lenders that historically, even over the last few years, that have been lending at 12%, 12.25%, a lot of those lenders have either stayed steady or they've only gone up maybe 50 basis points to 100 basis points. And it's like your data showed that the average is about 11, but a lot of lenders are pricing loans in the 12s and even in the 13 range.
That's right. Yeah, and I think there's a real appetite to try to increase yields, but it's very challenging, and so it's a tough needle to move. From what I've seen. And then, we talked about earlier in the presentation, but, this really does echo a little bit more about how, it's very important to understand this information now, parsing it at the county level or the regional level, those sorts of things, right? So, just the state of California that we're looking at here, and we're looking at the just Q2 was the analysis of this. So I said, let me look at transactions and the average interest rate, the coupon rate that we were seeing in transactions, show it to me by county and show it to me just for the months of April through June of this year. And you're seeing, a spread of almost, close to almost 100 basis points, 90 basis points from Riverside to Santa Clara. And you're also seeing disparate, items in here as well, right? So what are the number of loan transactions and those sorts of things? But, you've got an example here of Sacramento at average loan amount of $300,000 versus Orange County of more than twice that amount, right? So you really do need to understand what is the local market, what is that local market demand, and similarly, as you can get, appears almost 40 basis points more in Orange than you could have in Sacramento in the first place. So, when people say that 11 is the national average, that's right. And Rocky just kind of articulated the point, which is, yeah, well, but what is, where are you is probably going to dictate, and not only where are you in Massachusetts or something like that, but, where in Massachusetts are you is probably going to dictate whether you're at a 13 or whether you should be at an 11 based on, probably major metros,
Yeah, sorry, and even in California, I know a few lenders that are still lending at rates under 10%, but a lot of them are lenders that get their capital from high net worth investors, where they're okay with a lower yield, so the cost of capital is not as high. But that is a minority, unique case. But yeah, most of the lenders I've seen, even in California, that was historically a lot lower than the rest of the country, their minimum is typically 10%.
That's
or
right.
maybe even 10.5 if you take the average.
That's right. And I was curious about this as well, which is that, when we were looking at the data behind this, and I said, hey, let's look at 3 states. I'd asked for Texas, California, and Florida. And so the next day we're going to look at here is Florida. Similar, analysis being done, right? So when you're looking at Miami-Dade, that's also currently we're seeing as the highest interest rate environment that's currently available. But also some of the larger loan amounts that we're seeing for Florida, right? So average loan amount of about $600,000 there versus something like a Polk County where you're seeing, almost 1/4 of that, right, in the average loan amount. But interestingly enough, also almost 100 basis points lower in the actual interest rate as well. So really disparate results, probably showing to you that the fragmentation that we really still live, no matter how much you want to think about the national commoditization of private lending, it's still really a local club of activity, and it really there's a lot of spread that I suspect exists in any given market as well. The next one here is, like we talked about earlier, was going to be Texas, and so looking at the interest rates and the average loan amounts in Texas. I was really curious. I would maybe after this webinar I'll pop in and understand what the hell is going on in Denton. But apparently, if you want a very high rate of interest, at least for those 6 lovely transactions, we're getting good coupons out there. But I guess that's what happens when you write $150,000 loans. Better make the transaction worth it for me. So maybe that's the corollary that we're seeing here. But spreads, kind of hovering there in the 11.7 to 12.2, that's probably a much better understanding of what you're going to see in Texas today from an average interest rate environment. But you will see really disparate results as it pertains to the average loan amount there.
And as it relates to Texas and Florida, I've seen a ton of lenders that are really interested in those 2 states in particular, where they're not really that excited about the Western states. They really focus on the South and the Southeast, and those are the 2 hot markets right now, as far as I'm seeing.
Right. And most importantly, what you're all here for is I'll go ahead and give control over to you, Rick, and why don't you let us hear?
Well, looking for those controls. Let's see if we got them. Yep, it says I did that. I'm not sure how, but here we go. So we're going to cover an awful lot in a very short period of time here. So I'm going to kind of go through this at lightning duck speed. The slides will be available for everybody afterwards. So we're going to take a look at the overall U.S. economy. We're going to take a look at the housing market, what we're seeing in the mortgage industry, and we'll talk a little bit about delinquencies and foreclosures. So really a lot to cover. And as I said, we're going to kind of go through this pretty rapidly. So despite all of the discussion about recessions and whether the economy is going to be slowing down, and despite everything the Federal Reserve has been doing to try and slow down the economy, it continues to grow. The GDP, the gross domestic product, which is the metric that most economists use to determine the health of the economy, actually surprised to the upside in the second quarter of this year. We had growth at 2.4%, which was above consensus, and certainly flummoxed a lot of economists who were expecting things to start slowing down a bit. But the bottom line is that the overall economy continues to move forward at a fairly healthy clip. We'll talk a little bit about whether or not we're likely to see a recession in a couple of slides, but I wanted to point this out. And I also need to point out that a lot of what goes on in the economy is tied directly into consumer spending. So in the US, consumer spending accounts for about 65 to 70% of the GDP. Housing also contributes, business spending contributes, government spending contributes, but generally speaking, a lot of what we see in the market really is tied into what consumers are doing. Talking about the economy in general, unemployment is still near historically low levels. We've kind of been spoiled by unemployment rates as low as they've been for the last several years. Historically speaking, if we were at 5% unemployment, most economists would view that as being full employment. We've been at the 3.5% range for a number of years now. And in fact, there are still more jobs available than there are people looking for work. There's about 9.6 million job openings across the country. There's about 6 million people who are in the unemployment roll somewhere or looking for work. So we're in a very unusual set of circumstances in the country. And it's a good time if you're looking for a job. We have seen job creation slow down a bit in recent weeks. I think the last report that we saw just a couple of days ago was that there were about 187,000 jobs created in the most recent report. And created is a term that some people think has political implications. It's just the way it's been reported for years. But you see unemployment spiked back when the government shut everything down during the pandemic and has recovered rapidly. A lot of the jobs that have been filled since then have been jobs that really replaced those jobs that were lost during the pandemic. So these aren't all new jobs, but the fact of the matter is that the economy is still continuing to create new jobs as we move forward. Because there are more jobs available than there are people looking for work, it's put pressure on employers to compete for employees. And one of the ways they do that is by raising wages. So whether you're looking at U.S. average hourly wages, which is the blue bar there, or you're looking at wage and salary growth, which is the dotted line, both of those are very strong. Most recent numbers on annual wage growth came in at about 4.5%, which was a little bit below what you're seeing here. It came in a little over 5 in the previous month. But both of those are very healthy numbers, historically speaking. In fact, this is the first time in many years when I can tell you that wage growth is actually running higher than the rate of inflation, and it's actually running higher than home price appreciation. So after a decade or more where home prices were growing at a faster clip than wages were growing, we've seen that reverse in recent times. This is one of the areas that the Federal Reserve is paying very close attention to, because the concern is if wages grow too fast, it gives people too much money to spend. They compete for limited goods and services, which causes inflation. So it is something that the Fed is watching, and in order for the Fed to settle down, one of the things we're watching and seeing if it might happen is the kind of slowdown in job creation, which would keep wages from growing too quickly. The other thing that we're seeing is that good news that we're seeing is that inflation is still high, but appears to have peaked. So the dotted line you're looking at here is the rate of inflation. It peaked over 9%. That's the highest we've seen inflation go in over 40 years, almost 50 years. And because the Fed has been so aggressive in its approach to trying to get inflation under control, we've seen it come down pretty quickly. The last report came out at 3% year over year, which is within spitting distance of the Fed's 2% target. And the Board of Governors in the Federal Reserve is public with its split right now in terms of what they do next. The market is running about 50-50 on whether they think the Fed has one more rate hike in them this year. But some of the governors, including Raphael Bostic from Atlanta, who has a lot of sway with the group, are suggesting that maybe at this point it's time for them to take a step back, pause, and see if what they've done already doesn't have its intended effect of bringing inflation down. I'm showing you this chart very purposefully. The shaded area you're looking at is the rate of inflation. What the Fed has done to raise the Fed funds rate in order to get inflation under control. And I wanted you to see this because it shows just how unusual the Fed's activity has been this cycle compared to previous cycles. If you go back to 2016, you see inflation started to jot up a little bit, and the Fed raised the Fed funds rate by a quarter point and waited for a while. And then they raised it a little bit more and a little bit more, but they did it in a very methodical step-by-step manner, and each time waiting to see if it had the desired effect. In this case, they admitted that they basically waited too long. They underestimated how high inflation was going to get. They underestimated how difficult it was going to be to get inflation down. And what that left them with was inflation that had spiked way above what they had anticipated. and they took the most aggressive action, I believe, in their history in terms of raising the Fed funds rate in consecutive meetings and at the kind of levels that they raised them. And they felt that they needed to take these aggressive actions in order to get inflation under control. But it's very likely that we're going to see those Fed funds rates stay higher longer than normal because the Fed is very afraid that if they reduce things, if they pivot, as what people are saying in the press, it could lead to a rebound in inflation. One of the concerns, one of the reasons that I believe that a recession is probably still more likely than not, even though a lot of prognosticators are now saying that maybe not a recession, maybe we'll see a soft landing, is that every time the Fed has done this in the past, they've basically overcorrected us into a recession. So this is a chart that was put together by the chief economist at Fannie Mae. He's using publicly available data, so I'm not stealing anything here. But if you go back as far as World War II, the Fed raised the Fed funds rate in order to get inflation under control 11 times, not counting the current cycle. 8 of those 11 times, they kind of waited too long, waited until inflation got too high, had to correct kind of aggressively. And every time they did that, it led to a recession. There are 3 green arrows here. Those are the 3 times that the Fed raised the Fed funds rate and negotiated a soft landing, avoided a recession. What all 3 of those have in common is the Fed acted proactively and started to raise the Fed funds rate before inflation got too high. And as I mentioned, they've already admitted this time they waited too long, inflation got too high, and it wasn't as transitory as they had hoped. So history would suggest that they've probably already overcorrected a little bit, and it would be more likely than not that we would see a recession before all is said and done. The other historical data point I would give you is the yield curve inversion. I'm guessing most of you are familiar with this, and I don't want to go too inside baseball on everybody, but basically, this is when the bond market decides that there's blood in the water or there's a disruption in the force. And what happens is that while normally the yield on a 10-year bond is higher than the yield on a 2-year bond because it's a longer investment, there's more risk involved, and so forth and so on, these 2 guys switch places. And so the yields on the 2-year become higher than the yield on the 10-year. That very often happens when the Fed raises the Fed funds rate because your overnight rates have gone up. And that kind of drives everybody up along with it. Well, the last 7 times in a row that there's been a yield curve inversion, it's been followed by a recession. So a yield curve inversion doesn't cause a recession, but it's become probably the most accurate predictor of one coming. And this yield curve inversion, which is at the far right-hand side of the chart, is one of the deeper ones we've had. Really, since the 1980s, it's the deepest one we've had, and it's been going on the longest. And so again, history points, if you look at it as a precedent, toward the likelihood of us seeing a recession before all the dust settles. What I will say is that if we do have a recession, and if we do, it probably won't happen until early next year. But if we do have a recession, everything else in the economy is really hitting on all cylinders right now. And so the likelihood is that whatever recession we might have should be fairly mild and fairly short. So it's not the kind of thing where we're likely to see unemployment spike back up to 7% or anything like that. And it should be something that we kind of work our way out of fairly quickly. So that's my silver lining for that cloud in the event that we do see a recession coming. What the Fed has done has really roiled the financial markets and had a material effect on mortgages, which has had a material effect on all lending, including private lending. The interest rates that the gentlemen were, or that Rocky and Nema were talking about earlier in the private lending market, clearly much higher than they were a year or 2 ago, and are reflective of kind of the increase we're seeing in the consumer mortgage market. Now, this data, just to show you how quickly things change, this data is from the last week in July. We're now in early August, and we've been seeing mortgage rates up in the 7s for consumers. There are a couple things to keep in mind here. One is that mortgage rates really for the last, I would say, 6 to 8 weeks have been trading in a fairly narrow band between about 6.5% and a little over 7%. I believe they'll continue to trade there for the rest of August and probably into September, while the market's waiting to see what the Fed does at its September meeting. Assuming the Fed doesn't do anything completely unanticipated, I do believe that as we go through the rest of the year, rates will start to come down. If you look at reports from Freddie Mac, historically speaking, every time the Fed has stopped its Fed funds rate hike cycles, we've started to see mortgage rates come down. And one of the other factors that I believe indicates that we should see mortgage rates come down is the spread. And the spread is between the yield on a 10-year US Treasury and the rates charged on a 30-year fixed rate mortgage. There is a pretty strong correlation between those two. And in a normal market, the spread between the yield on a 10-year and the interest rate on a 30-year fixed rate mortgage is between 1.5% and 2%. So at today's rate, you have a yield of about 4% on the Treasury. We would normally be seeing mortgage rates between 5.5% and 6%. We're actually seeing mortgage rates a little higher than 7%. So there's a full 100 basis points, a full 1% percentage rate in terms of mortgage rates that we could get to if that spread just normalized. And a big reason for the spread today is the perceived volatility and risk that the market is priced into mortgages because they're not really sure what the Fed's going to do next. So it would not be completely unusual to see interest rates back down in the mid to low sixes by the time we get to the end of this year, if the Fed signals that its rate hike cycle is done. What that means for borrowers, it is very, very material, very, very significant. What we've seen over the last year, and this chart shows the MBA, the Mortgage Bankers Association's purchase loan index compared to existing home sales. And the purchase loan index is simply how many people are applying for a loan to buy a house. That's down about 30% from a year ago. And keep in mind, a year ago at this point, interest rates had already started to go up. So it's a pretty significant drop off in purchase applications. What I'm not showing you is the refinance chart, which would be even more depressing. If you go back 2 years and look at it today, I believe refi activity is off somewhere in the neighborhood of 85%. So if 93% of homeowners with a mortgage have a rate of 6% or lower, and 70% have a mortgage rate of 4% or lower, it just doesn't do them much good to refinance into a 7% mortgage. So the refi business is probably going to be in the doldrums for the next couple of years until rates get back to a more reasonable number. This is another chart from the MBA, and it's just showing their forecasts for overall mortgage volume. Excuse me. The blue line you're looking at there is purchase loans, and the red line you're looking at there is refis. And the MBA does have some forecasts which show mortgage rates getting down into the fives over the next couple of years, which is where you start to see an increase in both of those types of activity. But you can see that after an almost record year a couple of years ago, we saw less than half of that volume a year ago. The number is going to continue to go down this year, and we don't quite get back to 2022 levels, even as we go into next year's forecast. So not a banner forecast going forward, but I would point to something here that will fly in the face of everybody who's trying to sell you something on YouTube, predicting a dramatic and drastic housing market crash. This recovery, this correction looks much more like something we might have seen in the late 80s, which is home sales volume that was just kind of unexciting for a few years as the market recovered. It looks nothing like what we saw during the market crash in 2008 through 2011, where prices dropped by 30% nationally, 15-60% in markets like California and Florida, and home sales volume dried up. We're probably going to bottom out in terms of existing home sales this year and start a very gradual recovery for the next couple of years while people adjust to higher prices and higher financing costs. So not a crash, at least not from my perspective, not from the MBA's perspective, not from forecasts I've seen from Fannie Mae and Freddie Mac. So most of the economists that I follow do believe that this year probably will be the bottom and that we'll start to see volume improve next year. Pending home sales, which is the other demand indicator that I follow, I take a look at the purchase loan index and pending home sales, are also down significantly year over year. This is as close as the industry gets to predicting anything, and it's really not much of a prediction because it's actually showing contracts that are signed. So the recording hasn't taken place, the deed hasn't been issued yet, but this is pending home sales contracts that have been signed. They're down significantly on a year-over-year basis. You see a little blip, which happened in March when interest rates dipped just a little bit. We saw people coming back onto the market. And again, if I'm right, and if we start to see mortgage rates come down in the second half of this year, there will be no shortage of buyers. We do have some issues with inventory that I'll share with you in a couple slides, but people are very, very rate sensitive right now. Because of everything we've talked about, no surprise that existing home sales are way down. When we started this year, and I think I spoke at a Jurassic event not too long ago talking about this, but my forecast for the year was we'd see between 4.3 and 4.4 million existing home sales. If you look at June numbers and annualize them, we're right at 4.28 million. Now, if we come in at 4.3 million this year, that's down from about 5.2 million a year ago and down from about 6.2 million the year before that. Getting back to around 5 million in terms of sales would feel a lot more like normal. But we are now at 22 consecutive months where the number of existing homes sold is lower than it was the prior year. Last year's numbers, the blue bars you're looking at there, it was a very, very unusual chart. I've never seen this before. I can't guarantee that it's never happened before, but I've never seen a year where January was the highest month of existing home sales, and every month after that consecutively had fewer sales. That means we basically wiped out the spring and summer selling season. And with June sales being a little lower than May sales this year, we could be looking at another very lackluster spring and summer selling season, which again doesn't bode well for the real estate industry in general. There are some markets that are doing better than others, and this is some data from Realtor.com, and they're looking not just at closed transactions, but they're also looking at searches where people are looking for homes. And interestingly, it looks like the markets where we're seeing a lot of the activity, a lot of the growth are in the Midwest and the Mid-Atlantic regions. I would submit that some of the data that Nema and Rocky were sharing with you a little earlier, particularly when it comes to the single family rental market, are also happening in those regions. One of the reasons I believe that the average loan balance on an SFR loan is different than what you're seeing on a fix and flip loan is simply that the people buying those properties are looking at less expensive markets. And they're doing that because it's easier for them to pencil out a more viable return on investment than it is if you're buying a rental property in Newport Beach and have to find somebody who can spend $13,000 a year on rent or $13,000 a month on rent. We are seeing some California markets getting a little bit more active in terms of search activity. And what's interesting there is if we really zoomed in on those markets, you would find that they're not necessarily along the coast as they appear to be, but there's some really more in the Central Valley and the inland areas of California, again, where prices are a little bit less expensive. I'm pointing this out because as much as we all talk about a national market, and I'm glad Nema mentioned this earlier, there really is no such thing as a national housing market. And you have to really know what's going on in your local area. So whether we're talking about activity or we're talking about prices, the correction I'm seeing in terms of prices is very, very different in coastal California, the Pacific Northwest, some of the markets that were just booming during the pandemic, like Boise, Idaho, and Salt Lake City, Utah, and Phoenix, Arizona. And Austin, Texas, where we're seeing prices down 10% year over year. On the other hand, Florida, the southeastern states, the Carolinas, Tennessee, everywhere else in Texas except for Austin, we're seeing prices up year over year. So it's almost important to disregard what you're seeing in terms of national price trends and really zero in on what's happening in your market. One of the reasons we're not going to see more home sales this year, and by the way, one of the most important reasons we're not seeing home prices crash, is that there's simply nothing for sale. The red line you're looking at here is current inventory. This is from Altos Research, and they look at things on a 7-day rolling average. This is why the numbers are a little lower than what you see with some of the other reports that'll look at quarterly inventory or monthly inventory. But however you're looking at it, inventory levels today are down about 50% from where we were in 2019, which I would submit is probably the last normal year we had for housing sales. They're also down about 9% year over year, which is pretty significant because we didn't have a ton of inventory last year. And we're also not seeing the kind of curve upward that we normally see this time of year. So all factors suggesting that inventory levels are going to remain low nationally. And again, I know I just said there's no such thing as a national market, but let me contradict myself. Nationally, there's about a 2.5-month supply of homes available for sale. If you look at things historically, the mean, what we're looking for in a balanced market is about a 6-month supply. So we're running at about half of those levels. So even though demand is down because affordability has been hampered, there's enough demand to easily gobble up the limited amount of properties that are available for sale. In some markets, I just happened to be doing something. I was looking at Richmond, Virginia the other day for a client, and the inventory there is about a 1.5-month supply. So just very little inventory going around and almost nothing in the way of new listings. The only reason the inventory looks as good as it does is because it's taking a little longer to sell properties once they're listed. But new listing activity is actually lower, even though what we just talked about. Price appreciation has been coming down. Up until recent months, it was still positive net on a year-over-year basis, but did go negative in the NAR analysis several months ago. It broke a 48-month streak of prices going up on a year-over-year basis, and was down consecutively for 3 months until June. And June prices bounced back, even as sales volume dropped off. What's significant about that is if you look at those June prices, we're actually only off 0.9% from last year's peak prices. So existing home sales, the prices may have bottomed out and may be on their way back up, even in spite of the fact that the financing costs are as high as they are. So it wouldn't be surprising to see July numbers actually positive year over year. If you look at the FHFA prices, and this is basically every loan that's guaranteed by Fannie Mae and Freddie Mac, they're actually positive year over year nationally, about 2.8, almost 3%. And there are only 2 regions. And remember the regions I was talking about as having the biggest corrections. So the Pacific region and the Mountain region are the 2 that are a little bit negative. But even at that, I mean, for people that were predicting 20-30% price corrections, look at that Mountain region down a whopping 2.7% year over year. Remember that just a couple of years ago, Boise home prices were up 47% year over year. So we are seeing a correction, but nothing like what people were expecting. And those positive numbers you see to the right of those are all in line with what we would normally see in terms of price appreciation year over year. Historically speaking, on an average year, home prices go up about 3.5 to 4% nationally. So we're seeing kind of a return to normal if you look at it that way. New home sales have been acting a little differently. And that's because the builders are offering concessions to get people to buy. If you're a home builder and you have 5-6 properties at the end of a development sitting vacant, they're costing you money every month. So you're motivated to get rid of them. On the other hand, if you're a homeowner sitting on a 3.5% mortgage, and you realize that if you sold your house and bought a house for the same price as the one you sold yours for, your mortgage payments would go up by about 100% a month. There's no incentive for these homeowners to move their property. So until mortgage rates come down pretty significantly, we're going to continue to see existing home inventory very, very low. On the other hand, builders are offering incentives. They're offering upgrades. They're bringing cash to closing to pay down mortgage costs by buying points. And so we are seeing overall year to date, new home sales are still a little bit off where they were a year ago. But we're now in 3 consecutive months where the sales are higher than they were in the prior year. And I wouldn't be surprised if we continue to see that. So right now, if I were going to give you my best estimate, it's that we're going to wind up somewhere between 650 and 700,000 new homes sold this year. And there would be more, except the builders aren't building fast enough to have more of those properties sold. Again, one of the reasons for this is prices. And median new home prices are off 16% from peak. So juxtapose that with what we just said about existing homes being down less than 1% from peak. and the builders are moving. Now, this does not mean necessarily they're discounting existing properties. In a lot of cases, what they're doing is building new homes with smaller footprints, or they're building new homes with a lower price per square foot. But they are accommodating the market need for lower priced properties due to affordability issues. If anybody's expecting the builders to build their way out of this mess, that's not happening. The red line here is housing starts for single family residential units. And as you can see, they've been going steadily down. And they've been going down ever since last year when interest rates went up and buyer demand reduced. So the builders got caught short during the last boom and bust cycle. They kept building even after demand slowed down. And because of that, they were left with a glut of inventory. It took them a while to build through, and they've candidly been underbuilding now for the last 15 years. So they had been coming back until the market conditions changed last year, but they're not going to overbuild by any stretch of the imagination this time. And just to show you what's going on, and I apologize, this is a little bit of an eye test, but the blue line you're looking at here is the number of properties under construction, the months of inventory of properties under construction. The red line is properties that are completed, and the gray line is basically properties where permits have been issued. And about a year ago, we had a really anomalous situation where we had the highest number of properties under construction in the history of this data, which goes back to the 1970s. And we had the lowest number of properties completed. And it was largely due to supply chain disruption and labor shortages. It was just taking builders longer to build properties. These two numbers are gradually getting back to normal. The properties completed aren't rising as quickly as they might, because people are buying these properties while they're still under construction. The good news for the future is that we are seeing a lot of permitting. And so that suggests that the builders are looking toward more robust housing starts as they see market conditions begin to improve. Investors are clearly a big part of the market. In the most recent quarter in Q2, investors and cash buyers accounted for about 42% of all residential home purchases. That's down from 45% the prior quarter, but it's still relatively high historically speaking. And I suspect this will continue over the next couple of quarters as traditional home buyers kind of sit on the sidelines waiting for mortgage rates to get better. Interestingly, all that investor activity has not caused home ownership rates to decline. That big spike you see, by the way, is right before the housing market crashed back in 2008. But despite the fact that we see a lot of investor activity, we're certainly not going to a renter nation anytime soon. Home ownership rates are still right around 65, 66%. What has been interesting is that a study I just did for a private lender showed that of the 300 plus people who participated in the survey, almost twice as many have moved to a buy and rent strategy as have pursued a fix and flip strategy. That's probably a short-term trend. If I'd taken the survey a year ago, I would have gotten almost exactly opposite results. But one of the things that Rocky and Nema mentioned earlier is that a lot of the new investors are moving toward rentals. It's not showing up in the kind of same investor activity on a year-over-year basis. But I'm going to guess a lot of these people are probably new and coming into the market and see more of a short-term opportunity for rentals, because a lot of the people who would have been buyers have voted themselves out of the market for the time being because they simply can't afford to buy the property they wanted. According to Adam, the first quarter of this year was the lowest number of flips we've seen in about 2 years, 70,000 flips, fourth consecutive quarter where there were fewer flips than the quarter prior. I'm of the opinion, based on some of the market data I've seen elsewhere, that might be the bottom, and the next quarter's numbers could actually go up a little bit. The other thing they reported on, I don't have a chart for this, was that gross profits for flippers actually went positive for the first time in a number of months. So gross is simply what you paid versus what you sold. Doesn't take into account financing costs, carrying costs, repair costs, anything else. But it's the first time in many months where we've seen a gross profit increase. I'm going to go through this last section as quickly as possible because I know we're at the bottom of the hour. But if you're expecting a flood of foreclosures, I have some bad news for you. Isn't likely to happen anytime soon. And if you look at the MBA's delinquency rates, There's always a strong correlation between unemployment rates and delinquency rates on mortgage loans. If you go back to the first quarter, at the end of the first quarter, unemployment was 3.5%. And the mortgage delinquency rates were at 3.56%. Can't get a much stronger correlation than that. Also important to note that historically speaking, your normal delinquency rate is between 4 and 5%. So we're actually below normal levels of delinquency. It's a testament to the strength of the economy and to the quality of the people who have loans that they've taken out. Everybody's paying their loans. Foreclosure activity, if you're looking at total number of foreclosure actions through the first half of the year, we're running at about 63% of 2019 levels. I should point out that 2019 was not a big year for foreclosures. It was actually a little bit less than normal levels of foreclosure activity. In a normal year, about 1 to 1.5% of all loans are in foreclosure. Today, we're looking at about 0.6% of loans being in foreclosure. And it varies depending on the stage of foreclosure you're looking at and where you are in the country. So if you're looking at New York State, they're back to close to normal levels, about 1.5%. If you're looking at states like California and Arizona, you're down at about 0.2%. So again, it varies. The blue bars here are all states that do judicial foreclosures. One of the reasons most of those percentages are higher is that it just takes much, much longer to go through the foreclosure process once somebody's in that loop. And in New York State, for example, on average, it takes 2,400 days to do a foreclosure. Whereas in Texas, it's about 60 days. So that's one of the reasons you see a higher percentage of loans in New York State in foreclosure. If you look at foreclosure starts, that first legal notice that somebody gets, those are back to about 80% of pre-pandemic levels. And I expect they'll be back to 2019 levels probably by the first quarter of next year. But we are seeing more people get that first foreclosure notice as lenders kind of work their way through the process. The number of properties getting to foreclosure auction is running at about 50% of where we were prior to the pandemic. So we're seeing almost as many properties get that first notice, but only half as many get to auction. This is according to auction.com, and they do probably about 50% of all these auctions nationally. And the repossession levels are running at about 30% of pre-pandemic levels. So if your investors are waiting for properties to be repossessed by the lenders and selling them, that's not the right behavior this cycle. They really need to be going upstream and looking to work with distressed borrowers on negotiating a deal. One of the reasons we're seeing fewer properties being repossessed and fewer properties getting to auction is that 92% of the borrowers in foreclosure have positive equity. And they actually have a lot of positive equity. 88% of borrowers in foreclosure have at least 20% equity. So what's happening is they're selling these properties in the early stages of foreclosure, rather than risking losing all that equity at a foreclosure sale. So prior to the pandemic, you were seeing more than 50% of distressed properties sold as REOs, as bank-owned properties. Today, that number is down to 19%, and you're seeing about 2/3 of the properties that are distressed sales being sold by the owner prior to the foreclosure auction. So very, very different market conditions than what we saw the last time around. And I mentioned how long it's taking to do a foreclosure. So a property going into foreclosure today, on average nationally, won't be foreclosed on, won't be through the process for over 2 years. That number will come down. It's inflated a little bit by the forbearance program that's finally wrapping up that was part of the COVID CARES Act. But this is about the highest number of days Adam has ever tracked in terms of executing a foreclosure. So to wrap up, and I apologize for running a little over, but from my perspective, I think a recession is still more likely than not. But if we have one, probably won't be till next year, and it'll be fairly short and mild. Unemployment really shouldn't get much above 5.5% at the outside. Mortgage rates should gradually decline back towards 6% by the end of the year, unless we have an upside surprise in inflation or the Fed does something unexpected. Existing home sales are on pace for the lowest number since 2019. New home sales may be a little stronger than expected. Prices continue to decline in the new home market, but may have bottomed out for existing homes. And investors will continue to be very active and maybe shifting at least short term to more of a buy and hold strategy. And finally, the anticipated wave of foreclosure some people were predicting didn't happen and doesn't seem likely to happen anytime soon. So with that, Nema, thank you for inviting me to participate today. I enjoyed doing this with you and Rocky, and hopefully some of this data was useful to the attendees.
No, thank you, Rick. And, as always, it's like drinking from a fire hose when you present. It's awesome. Always learn something new here. Thank you for everyone for participating. There was some questions about releasing the slides. When we release the video in a couple of weeks with AAPL, we'll happily deliver the slides at that time as well. And so expect an email from AAPL at that time. Otherwise, hopefully you've gotten value out of today's presentation. We really appreciate you all taking the time out of your day. And for those of you that hopefully I'll be getting to see a lot of you at our upcoming conference in a couple of weeks here at the Captivate conference. Otherwise, I'm sure we'll see you at AAPL in a month or two here. So looking forward to catching up with you in person. All right, everyone, take care and have a wonderful day.